The market has suddenly turned really, really nasty. It's kind of a slow rolling nasty. Many stocks are still so close to their highs that you feel like a real chump buying them here. So why don't we do this? I'm going to tell you how you can tell when a decline is really creating bargains and when it's really just creating, let's say, fugazis. That's my new word for it. Let me walk you through some of my favorite companies in the Dow Jones Industrial Average, show you how it's done. This is what you would do at a hedge fund or a mutual fund. It's kind of a check-down approach. Best performer in the Dow this year, Apple, up 39%. But Apple's only off about 3% from its highs. Oh, that might be tempting in a different environment, but we're back in hostage land when it comes to the trade war with China, especially with some new investment rules that could hurt China being mused about right now at the White House, the story I broke at the top of the show. So once again, I say own Apple, don't trade it. In this case, that means don't start a new position. And at this level, I don't believe the negotiations with the Chinese are going to be magical, and that means you can be patient. Let it come in. Next is Microsoft. Now, Microsoft's up 36% for the year, but it's only down 3% from its high. To me, that's just too close to that. There's no compelling reason to say right here, right now, I want to own Microsoft. Down 3%. What's that? All right, how about Procter & Gamble? This is up 36% for the year. It just made a new all-time high yesterday. Does that make it tempting? Not to me. To me, it feels like an accident waiting to happen if you buy it at its all-time high. If you buy Procter here and it drops 2 points, you'll be frozen. And you'll be talking about how you top-ticked it, and you get a bad day, and you'll kick it out, and you'll take a loss. You never want to feel like you've come in at the top of it for a big run. It messes with your head, makes you way too vulnerable to potential disappointments. Remember, this is a psychological piece, not more than it is, say, mathematical, arithmetical, or financial piece. Now, same goes for reasoning for Home Depot. It's up 34%. It's right at the top. We get one nasty analyst note, and this thing will come down at least $3, maybe $5. While I'm a huge believer in the despot, as you know, the stock has gotten darn close to the high. Well, let's say the stock today was pretty high level. You know, we sold some this week for the trust. You can read about that by joining the ActionAlertsPlus.com club, where we laid it out. We basically just said, geez, we've made so much money here. Bulls make money, bears make money, hogs get slaughtered. Next up, there's Visa. Now, this one's interesting. It's up 32% for the year. Okay, you can say that's nosebleed, but listen to this. It works for me. Why? Because Visa stock is now down 7% from its high. I love the ones that are down 5 to 7. Always a great place to start. Here's a high-quality company that's part of a much-loved financial technology cohort. Much love, that is, until the month of September began. Visa is a well-run company. It seems to be having an excellent quarter. Now, there's been a rotation back into the big banks and out of the fintechs like Visa. But as we get closer to earnings season, I bet that rotation will reverse itself, even though I have to tell you that Charlie Scharf being hired by Wells Fargo was fantastic for Charlie and great for Wells Fargo, and that helped the banks move again today. Now, I love situations like Visa, though. You're getting a great spot to start a position. You're not buying at the high, and the fundamentals are good, and you're getting it nice enough off the top that I feel it's a good place. Hey, 6 is United Technologies. It's rallied 28% year-to-date. It's another ideal selection. Off more than 5% from its highs. You know, I like that, 5 to 8, okay? Despite what's increasingly looked like a brilliant decision by Greg Hayes to merge with Raytheon and then split into 3 new companies. I think the market is loving the prospect of a new pure-play aerospace and defense stock that's not named Boeing. So United Technologies is absolutely worth buying here. It's filled with positive catalysts. You start here, you start on Monday into some sort of ugliness, and you build your position. What else? Walmart's up 27% for the year, only down 1% from its high. Might as well be Home Depot. To me, it's got to come down more. IBM's up 26% for the year, down 6% from its high. That is tricky. Because remember, I got that Red Hat acquisition? I have no edge. Now, Nike just blew away the numbers. Sorry, have to wait. Finally, how about this one? American Express. I think this is a terrific situation, maybe the best of all. You just got a 10% dividend boost with a buyback of 120 million shares. When you consider that Amex only has 829 million shares outstanding, it means they're repurchasing 15% of the share count. Like Visa, American Express is a fintech play that's levered to small, medium-sized businesses, with the stock at 13 times next year's earnings, down 8% from its highs. Too good to ignore. See, that's the kind of thing. I just love that. If you're looking for the ideal kind of stock to start buying in this difficult environment, look no further than American Express. But don't forget, I think that Visa is really, really interesting here. And, no, you know what? Let's just stick with Express. I know it's hard to go through all those different ones, but AXP is the best one, and then Visa, and then United Technologies. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.